right, good afternoon. Welcome to the live recap. The format's going to be just like yesterday. I'm going to go over my interpretation of the day, the main opportunities that I saw during the day, and the main lessons we can get out of it. And then we'll spend an extra 5 or 10 minutes to do any Q&A. So going into the open today, we knew that we were dealing with a strong market. It's been quite strong recently, and then in the overnight session, the market had already started to break out above yesterday's high. So the main question heading into the open is this now going to be a successful breakout, or can it turn into a false breakout? And anytime there's a breakout attempt taking place, we have to be open to either of those situations. Not every breakout is a successful breakout, right? So we were going to use 0375 to 0575, which was yesterday's high, as the breakout area and as the micro bull bear, and how the market behaved at that area would provide us with a pretty good tell on which side was now being more dominant. So if we continued holding above it, and this was a successful upside breakout on broad market strength and sustained upside momentum, well, in that situation, we could go up into initial resistance and 17 to 20. And we would be careful shorting the market in that situation, because if the market is truly in breakout mode, then even though we can get reactions at those zones, the market does not have to stop there. But if it turned into a false or failed breakout attempt, then we could get a move back down to 95 to 98, where there may or may not be a bounce. That's something we would have to assess in real time, and we would have to be careful on the long side, because at that point in time, the larger pattern would have changed, at least the pattern that is relevant to us would have changed, and it would be a false or failed breakout. And in that situation, the market does not have to stop at 95 to 98, and we could go down into 86 quarter to 89 quarter, and even 78 to 81, and then we would need to see a lot of downside momentum and broad market weakness to take out 86 quarter to 89 quarter and 78 to 81. So those were areas where buyers could defend on first test. But the main thing this morning was, is this now a successful breakout or not? That was the main question. And I think it's important to be aware of and focused on the right question so that we can get the correct and actionable market read, right? Because there's so much information coming at us from looking at all these charts and whatnot. And if we're not looking for the right thing, then it's going to be easy to miss. So part of the trade plan, at least what I focus on, is to direct that focus on the thing that matters every day, the main thing that is really relevant today. And this morning, that breakout was the relevant thing. So looking at the chart, we can see that the early opening price action actually started out fairly bullish. And it would be fine to even attempt a long setup either before the market opened, on this pullback into the micro bull bear, or even just trading the breakout itself around 2908 or 2909 as the market started to break out. And the first trade of the day for me was actually on the long side, right? I was playing the breakout. And at the same time, I'm watching the other markets. As you know, I covered this in the recaps. On my end, I don't look at a lot of information, but primarily I'm looking at the S&P, 1 and 5 minute chart, and I'm aware of the larger time frame. I'm looking at the Russell and NASDAQ 5 minute charts, along with the 30 minute and the internals. And that's really about it, right? So there's not too much more than that. And I noticed that the Russell was really struggling to go higher, which I kind of discounted, actually, because I thought, well, the Russell is kind of the weaker market anyway, so it's okay, maybe it'll kind of gain its footing, but it was definitely a red flag. NASDAQ was pretty strong off the open, so that was kind of reassuring for the long setup. But then we started to see even the Nasdaq kind of struggling, and I ended up getting out of that trade just in time. Like literally, I think maybe a few seconds before the big drop down. Ended up getting out at like 10 quarter or something because it just didn't really look right to me. It didn't really feel like this was really going to be that big upside breakout. And we already know that the market's overextended. It's now pushing into a previous balance area where there can be resistance. And in order to continue going higher, we do need to see that persistent upside momentum. So first trade of the day was on the long side, off the open, essentially trading the open drive in alignment with that idea that above the micro bull bear, we could get a breakout. And then when I noticed the weakness in the Russell and, even the Nasdaq kind of not really behaving the way I want, and then on the smaller time frame, on the 1 minute chart, it was a little more apparent, started getting pullbacks. Let me switch to the RTH only chart. So over here, really did not want to see this market pulling back much. If it's a legitimate open drive, then this little pullback is okay. But then from here, we should just go. We should hit the initial resistance zone. And when that wasn't happening, just ended up bailing on that trade. And, sometimes that's going to be the right call. But like with anything, when it comes to trading, it's not going to be spot on every single time. Sometimes I'll end up getting out and the market will still go higher. So I say that because, we all assess our trading decisions with the benefit of hindsight, with the benefit of knowing what happened. And it's very easy to be hard on ourselves and our decisions because now we know exactly what happened. So it's easy to say, well, I shouldn't have done that and I should have done that. But just keep in mind that in trading, it's about improving your decision making, doing the best you can with what you have. And on average, if you do more good than bad, you'll end up ahead, right? So it's not about every single decision, but overall, if your decision making is kind of heading in the right direction and your mistakes are not overshadowing your good decisions, then you can end up ahead. So you don't have to be perfect to be a profitable trader, right? None of us are perfect. All of us kind of deal with the same mental struggles, and it's just that some of us are further ahead than others. So we have different issues that we might be dealing with, or we might be, working on optimizing and getting better as opposed to getting profitable, right? So we're all at different spots in the journey, but we're all kind of dealing with something. So when you're looking at the recap and you're looking at the trade ideas, these are ideal trade ideas, and the execution isn't always spot on, right? Like in this case, I was able to get out thankfully, but in other cases, I'm not going to be able to get out. And I try to keep the daily recap at about 10 minutes. These live recaps tend to go much longer, but the normal ones, I tend to keep them at 10 to 15 minutes, so I can't discuss every possible idea and every little thing that I saw. But these live ones, since we do have people attending, I try to go a little bit longer, and these can be a little bit more insightful. So over here, I end up getting out of this trade. The market pushes down, and this is that swift rejection that I talked about in the morning video. That if we got a swift rejection above the micro bull bear, then that would be our clue that, hey, this is now turning into a false breakout. And that's what we got. When we got this big downside move, that was our cue that now we need to be looking for that false breakout scenario, and that means that we need to now shift our focus from the long side to the short side. Now, the ideal trade setup over here is when the market pops back up into the overnight high, right? So as ES pops back up into the overnight high, this is the ideal spot to short the market because you can short it here at 29.08. I had a resting order at 07.75. You can short it at 29.08 using a 4-point stop because your stop just has to be above this high, right? So if you're putting it at 12, that's a very safe place to have your stop loss because if this is indeed a false breakout, then the market should not go up to 12. It should not push to a new high. technically shouldn't get anywhere near the high, but just to be safe, we can put the stop at 12, take the trade at 08 or 07.75, using a 4-point stop. And on the downside, the first target is going to be the pre-market support zone. The next target is going to be the initial support zone. Now we can see that this gets rejected at the overnight high, and again, if you're watching the other markets, you'll notice that Nasdaq at that time was struggling with its high from yesterday. All right, so you want to be kind of aware of at least the basic levels for these other markets, like yesterday's high, yesterday's low, overnight high, overnight low. If there's a significant kind of range high that's coming up. So if you want to use the other markets, it is important to do at least some basic prep work on the other markets as well. And if I had time in the mornings, I would provide zones for the Nasdaq and the Russell. But given my schedule, there's just not enough time to publish all that information and provide it to you guys. But on my end, that's something I do. I'm aware of the main support and resistance areas for the Nasdaq and the Russell. And you have to have that, because without that, you're not going to have the context necessary to interpret what's happening in those other markets. So as ES pops up here, Nasdaq's kind of struggling with its overnight high, with its previous day's high. Russell had already shown us weakness, and Russell also pushed up into its high from yesterday at the same time. So that ended up being a very nice entry. But it all starts with the understanding that this swift rejection means that the false breakout scenario could be in play. Now, if you did not take it at 08, then by the time the market gets down into the pre-market support, I think things are more clear, right? We have more clarity on the type of day that this is becoming. Because over here, there's still, I think, some vagueness, because the market popped off of the VWAP and it was kind of struggling around the micro bull bear, but not quite failing there. So, if you're reading that and you're thinking, hey, I don't really know where this is going, that's okay. That's not a problem. Like, you don't have to short 08. There's still plenty of opportunity in the day. And I think that's an important lesson too. Just because you've missed the best spot to get on board doesn't mean that you have to now let go of the idea altogether and miss out on the remainder of the move, right? So if you miss a trade, it's okay. If there's a bigger theme in play, then find the next good spot to get on board. So 08 is ideal, but it's not necessary. So by the time the market comes down into pre-market support, now, we can see AD is rapidly trending lower. The NYC tick is completely below zero and printing some nice downside values. We hit pre-market support. It is a valid area of support. We end up getting a bounce off that area, and we end up going back up to 03. Now, as the market's popping back up, this is another good shorting opportunity. There are a couple of ways that you can get on board for this opportunity. One is that you can look at the swing high. You can measure it down to the swing low, and you'll see that this pop back up to like 0.2 is the 38% retracement of this move. That's one way to kind of estimate where you can get on board. Another good way to do it is just to look at the price action and figure out where the stop loss now needs to go. So you can see that over here there's all this kind of rejection that takes place, right? We build this little horizontal area and then we break down, and the high of this is 06. So if you're getting on board at 02, 02.5, that's a trade you can take with a 4-point stop, right? So you can work your way backwards to a good enough entry. So instead of trying to figure out, hey, exactly where do I get in, you can say, well, my stop has to go to 06.25. It's above all of this consolidation. It's above the micro bull bear, above yesterday's high, above the VPOC at the time. So there's a lot of stuff in between there. So I need my stop to be 0.6 quarter. And in this environment, it's okay to use a 4 to 5 point stop. So you take 0.6 quarter and you subtract 4 to 5 points, right? And that means that anywhere between 0.1 quarter to 0.2 quarter is a good enough price. So you don't have to time it perfectly. You don't have to try to get the best swing high or anything like that. You can just work back to arrive at a good enough price, because you can use a 4 to 5 point stop. And if this trade idea is going to work, then on the downside, it's probably going to go into the initial support zone. And that's where the previous close was. That's the gap fill. Given the level of weakness we were seeing in the Russell, given the false breakout pattern that was in play, given the fact that we were now seeing sustained downside momentum, the high of day was very likely in, and now the range expansion could happen to the downside, and the gap fill was a very high probability target at that point in time. So if you're shorting 0.2 or 0.2 quarter, 4 point stop, on the downside, you have at least about 14 to 15 points of reward potential, down into that initial support. So, anywhere between 3 to 4R is quite achievable, even off of the 0.2 area. So even if you're not short already, this is still a very good spot to get on board. And we can see that sellers step in, we get a break below the first hour low, we go down, test the VPOC. Now the market's just a little bit overdone, so there's a little bit of a bounce. We come back and we test the first hour low, and the market rejects, which is a good thing. That kind of confirms that the sellers are more dominant today. So very kind of textbook movement here. So we come back, we test the first hour low to the tick, then we struggle there. So now this is broken support acting as resistance and the first hour low. Now technically you could even short over here. Personally, I think you really should be on board already, because we're dealing with an overall bullish market environment. And in that type of environment, you want to be at least mindful of trade location. Again, it doesn't have to be the best location like 08, but it should be good enough that you can at least hold the trade. Now, that being said, technically 97 is resistance. This is broken support acting as resistance. It's not an entry that I personally wanted to take. Like this one I did take. This one had a resting order, but this one was just, for me, it was too aggressive. I didn't want to get involved. So even though it's valid, based on my risk tolerance, it's not a trade that I want to take here, but it is technically resistance. And if you were going to take it, you'd want your stop loss to be above this little swing high. So you'd want it to be probably around 2,900, right? So if you're taking 97, 2,900, there is still more than enough reward potential down into initial support. And then this was the target. For me, this was the exit, was the initial support zone. I was expecting a move into gap fill. I knew the market had potential to go lower, but because we're dealing with a market that is overall bullish, I did not want to stay or overstay on the short side. So when the market hit initial support, that's my exit. I'm out of the trade, knowing full well that, it could go down to 79 to 81, but it could just as well pop right back up into, the first hour low area and just consolidate. We never know what's going to happen next, so we have to make the best decision with the information that we have. And most traders are not going to get in at the swing high and get out at the swing low, right? The focus is really kind of capturing the middle. And as long as you're capturing majority of the move, it's good enough. Now, if you did hold your short down into, the 83 area, so 82.5 was the 100% range extension of the first hour range over here. So if you held it into that, that would be okay. Like momentum was still bearish. You don't have to get out at initial support if you don't want to. 82.5, 83 is a good spot to get out. And then the 79 to 81 is valid support. And by that point in time, we were pushing about the average range, right? So if we look at the range analysis section on the trader worksheet, the average RTH range is close to 30 points. So with the high of day being 29.11.5, by the time the market pushes down into that 79 to 81 support, you've pretty much used up your average range potential. And, we weren't seeing significantly above average volume that would suggest that we're going to get an above average range. Early in the session, we were seeing a bit more volume, but as the market day went on, volume actually started drying up a bit. So when the market hit 79 to 81, now if you're holding a short position, you definitely want to get out. There may not be much more left in it, and we're not seeing any excessive weakness on the downside, right? I mean, it's not like we're seeing a very negative advanced decline reading or anything like that. And again, the intermediate term bias is bullish. So we have to be mindful of the fact that we're taking a short setup in an overall bullish environment, and we just don't want to overstay on the short side. So you definitely want to be out by 79 to 81, and by the same token, the 79 to 81 area can be traded on the long side because it is this valid area of support. And if you recall from yesterday's video, the idea was that if we're holding above even the 79 to 81 area, the market can balance at higher prices. So you do want to be kind of aware of the market context where you're not just forgetting, what happened yesterday or what was discussed in yesterday's video. Ideally, you're aware of some of those ideas. They're not the main ones, but it's good to know that stuff. So the 79 to 81 is a good spot to get out, and at the same time, this can be taken on the long side simply because of the range of the day being used up, and because it's good location. The market is now overdone to the downside, and we can get short covering here, we can get new buying here. There's potential for bounce. So this ends up being a nice trade back up into this broken support, which is now acting as resistance. You can see this area over here at 91 can be used as resistance. This is the spot where we bounced earlier. It's also the acceleration point over here. So as the day is progressing, you want to be mindful of these new real-time levels that are being generated. Key swing highs, key swing lows, and launching points of directional movement or launching points of breakouts and breakdowns. So as the market pops back up into 91, that's the exit, right? Because the day's bias is bearish, right? The intraday bias is bearish. So we don't want to overstay on the long side either. So if you did go long, anywhere within the zone, when the market pops back up into the 89 to 91 area, good spot to take profit. And I would just end it right there. I don't think it's really worthwhile to continue putting risk on. Even though this is technically resistance and technically you could short it, at the same time the market is making pretty decent upside tick readings. It wouldn't take a whole lot for it to drift a little bit higher. And when you're considering taking a trade, you have to be mindful of the reward to risk. So if you're shorting at 91, where does the stop go? Is it 95, 96? You may not get another 8 to 10 points to the downside off that area. So the reward to risk is not that great. It's not really ideal location. So this is not a short that I personally considered. If it had gone up into the 96 to 98 area up here, that would be better because now the location's better. You can take it with a tighter stop. You don't need a massive move to make that trade work out, and even a reaction would be sufficient to give you 2R. But here, the market really does have to go all the way back down to the lows to make this trade work, and that may or may not happen. So the best trades were already done, in my opinion, and we're really more active in the mornings. I'm personally much more focused and active in the mornings, and the afternoon sessions, usually I won't even bother putting a trade on unless we're dealing with like a trend day or something unusual. So that is how today ended up playing out on this end. I think it was a much better day compared to some of the days we've had recently where things have been very unclear, or the market has been going up on very little momentum, on very mediocre advanced decline readings. So the expectation was for better opportunities this week. And so far, the market has delivered that. And today, I think, was a very high opportunity day because we got a clear indication right off the open. We got a clear rejection and failure early in the session, which then set the bias for the remainder of the session. So, once we got this downside move, that really cleared things up in terms of what side we need to focus on. And then when we went down to pre-market support, now it was really clear what side we should focus on. And that's why, today they're providing some very high probability trade ideas. All right, guys, so that was today. At this point, I'll take a couple of questions and then we'll wrap this up. So Joe's question is regarding, so there was a question posted on Twitter today asking, would we still go long at initial support? And my response was, well, it depends on how the market gets there. If it bounces a lot earlier, so the question was asked, I think, when the market was trading, I want to say like maybe over here somewhere, I don't remember exactly, but this hadn't happened yet. And the idea was, do we still go long at initial support? And the response that I posted was, well, it depends on whether the market is able to put in a better pop so that by the time it gets there, it's really overdone. And if that's the case, then we may consider it. And if not, then we're not going to go long there, right? So the idea is that if the market had popped, let's say, much higher, so it didn't reject at 97, but let's say that, it went actually back up into the 2900 area and then slammed down into the 86 to 89 area, well, in that case, there's probably going to be a reaction. And a good enough reaction that would justify taking a long setup. But in this case, we go down from 97, and there's still a reaction. Like, it's not like the market just slices through it, but it's just not good enough. For me, it wasn't really good enough to go long at initial support. The range of the day wasn't really exhausted yet. So it's a trade you can take, if you want to try it out, and just play more defense with it because, it could go a little bit higher. Again, none of us knows what's going to happen next. So, it's something you could try out. To me, it wasn't worthwhile because the day's bias was clearly bearish. The first hour low had already been tested and rejected. I think another situation where it would make sense to go long is if the market had just gone down straight from here. So like, if it hadn't popped already to 97, that's another situation where it would make sense to consider going long at initial support because now the swing high would be over here around 2902.03. So the market would be really overdone by the time it got there. And we could target a move back into 95 to 97. But because, the market already popped here and then went down, not quite as good of a trade idea. So the next question here is, why do you not like the short at the first hour low? To me, the market's already moved quite a bit, and it wouldn't take a whole lot for it to pop up to like, the 24-hour mid. And again, that's because we're dealing with an overall bullish market. It would be very different if the intermediate term bias was bearish, right? But this is a situation where the intermediate term bias is bullish. So you do have to be a little bit more careful on the short side. So in a bullish environment, the market didn't have to stop at 97. It could have gone up a little bit higher and then headed down, right? That's why I personally didn't do it. But like I mentioned earlier, it would be okay to take it. It's just for me, for my risk tolerance, I didn't want to take it. And I was already short, right? So that's the other thing. I was already holding a short position. So to me, it wasn't good enough to add to my position and get, super aggressive on the short side. Maybe if I wasn't already short, I might have considered it, but I was already short, so I didn't really pay much attention to it. So Rob's question is, I keep letting myself get influenced by only thinking one way, bullish or bearish. How can I better train myself to keep an open mind. In terms of being open to either direction, it's it's not easy. It is challenging because sometimes there is just indecision in the market. Like, we're not bullish or bearish, right? That's why on certain days the bias is neutral because we're not really leaning big one way or the other. And in terms of bias, I think you just really have to be aware of kind of the current relevant pattern that's in play. And it's not about trend, right? Like if we look at the 5-minute chart for the overnight, it's clearly trending to the upside, right? So bias is not the same as trend. This market's clearly trending higher earlier in the session. It's really more about being aware of the key pattern and what has to happen for that trend to continue, for example, right? And I think it just takes some practice, of course, like anything, but over time, you really want to train yourself that you're not internally biased one way or the other. Like you're not rooting for one side. Like if you're rooting for one side, that's usually a clue that you're probably not looking at the market very objectively. So you want to be aware of that and then catch that. It's going to happen. Happens to all of us where, we can be kind of biased in one direction, but as long as you're aware of that and you can catch it and you can kind of course correct or calibrate for that, I think that usually solves the problem. But I think, to truly kind of develop not just a mindset, but a technical view that allows you to be open to bullish and bearish scenarios, I think it just requires, along with kind of working on the mindset and psychology, it also requires a deeper understanding on the technical side. A lot of issues get attributed to trading psychology, but they're not psychological issues. It's just a lack of training. It's just a lack of, understanding of the actual technicals and, how this whole thing kind of works. So some of it could be attributed to that too, right? And maybe you just need more practice. Scott's question is, do you think we had a good chance to make it back to the VWAP when we pushed off the 79 to 81 area? I wouldn't target the VWAP. Like if you're going long there, given the structure of the day, and clearly it's a bearish day, I wouldn't target a move back to VWAP. I think it's too high. I think it's too aggressive for today. The market's kind of sold off too much to pop all the way back up into the VWAP and, into that mid area. I would really just kind of look for, this swing high being tested, this swing low and swing high combination here, right here. This is what I would shoot for at the most. And even if you got out ahead of that, that would be fine too. I think VWAP is a bit much today. Eve's question is, even if we scale out, how do we mentally prepare for a pullback of 4 to 10 points that's 1 to 2R without getting scared and then exit ES, kind of when it comes back towards our entry, which happens very often? Well, I think you have to remind yourself that the whole point of scaling out is so you don't get so scared on the remainder of the position. Keep in mind that typically scaling out is going to produce less of a profit than if you had held your entire position. So there is an actual cost to scaling out. And you have to question, what are you paying for? Like, why are you paying that cost of scaling out? Well, you're doing it really to make it easier on yourself psychologically to hold the remainder of your trade. So I think if you just remind yourself of that look, you've already scaled out, I'm risk-free, right? Worst case scenario, it's a break-even trade. And just remind yourself that you paid a cost. You paid to scale out. It's technically costing you money to scale out. So the reason you're doing it is so you can hold that other part of the position into target. And if you can't do that, then obviously, you need to work on that. But that's the whole point of scaling out, is so that you're not mismanaging the remainder of your position, because now you've reduced your risk. And if you're scaling out of half of your position, you've gone probably risk-free at that point. Like there's no way you're going to lose on that overall trade. So I think just remind yourself of that, and remind yourself that there is a cost to scaling out, and that should help. Paul's question is, do you ever lean on the VWAP as a clue for the current short-term intraday trend? Yeah, I mean, if the market is in trend mode, it should hold on one side of the VWAP, right? So like if we're trending higher, the market should hold the VWAP. And if we're trending lower, then it should hold below the VWAP. So you can use that principle, and you can see how the market is behaving at the VWAP to give you an idea of the type of market you're dealing with. If it's not respecting the VWAP, then either we're getting a change of trend or we're dealing with a two-sided balanced market. So yeah, I think that how the market behaves around the VWAP can definitely provide a clue as to which side is being dominant, but just understand that if the market is in a balancing mode, kind of a two-sided mode, going just back and forth, then the VWAP is not going to be a key level that we're going to use, because in that scenario, the market's going to keep on trading around the VWAP, right? So the time the VWAP is helpful is when you think that the market is trending, and then it starts breaking below the VWAP or above the VWAP. For example, today, you can see overnight, the market held above the VWAP. And then our main thing was, hey, is this going to be a breakout? And then we got that, big move down over here. We hit the VWAP, we hold, and then we slice right through it, right? So that right away tells us that, okay, we're not trending to the upside anymore. It just further confirms the false breakout pattern. And that's why, earlier I was saying that by the time the market got to pre-market support, now things were very clear. Because now, we had a false breakout pattern in play. We had failed at the overnight high. We had failed at the micro bull bear. And we had now sliced below the VWAP. So all of those things are definitely helpful. Jade's saying I was caught in going long at the VWAP after the first drop in the morning because I felt like although it could be a false breakout, it could still be at a point where it could continue higher. What told you that breaking below yesterday's high should make us bearish? Just so you know, I did get short and I enjoyed the ride down. Just wondering how you knew. Well, number one, we never know with 100% certainty, what the market's going to do. But the idea is that if the market's going to continue heading higher, then, this breakout is really what needs to hold. And if it doesn't hold, then there's definitely some cracks in the foundation there, and it can lead to a move lower. And I think that, if you went long at the VWAP, like over here, and then you were holding thinking, hey, this may be a false breakout, it may not be, that's not a problem. I don't see that as an issue. I think that's okay. I think by the time we got to pre-market support, that's where things got really clear. I think that over here, you could technically make a case either way. That, hey, the market could still go higher, it could still go lower. I mean, things weren't as clear over here. And that's why if you are going to short over here, it needs to be near the overnight high. Because there is a lack of clarity. There is kind of that ambiguity in real time where we don't quite know, hey, is it going higher? Is it going to still continue? Or is it going to fail? Like, we don't know yet. We don't have that high confidence yet. And when that's the case, you have to get good location. And if you don't have good location, it's going to be very difficult to hold that kind of trade. And that's why, the short has to be off the overnight high here. You can't really short in the middle of this range. That's going to make it very difficult to hold this trade. But once we broke down and got into pre-market support, that's where things became very clear. And that's why now you can be aggressive and get on board at 29.01. 75 to 02 half or something, and that works out really well. Eve's question is, do you know or do you have a rule of how many zone fades you'll take, how many failed zone fades you'll take before you stop trading? I don't have a particular number in terms of like, oh, I'm only going to fade 2 zones and that's it. It really depends on the day, and That's the thing. Those simplistic rules, like, oh, we're only going to fade 1 or 2 times, then we're going to stop, or we're only going to do this, X number of times. It doesn't really work in the long run because it doesn't adapt to the market environment. Those simplistic rules that don't take the current situation into account, they don't really work out that well. And we don't really have the time to go into a detailed discussion of kind of how to figure out the number of zone fades you can take. So Tong's question here is regarding the move down into support, saying that even though the bias is bearish, we can still consider taking that trade because we're giving the zone and the exhaustion more weight than the bearish intraday bias. And yeah, that's correct. So if you're going long at this zone, then even though the day's bias is bearish, it doesn't mean that we're in a trend day, right? Even though day's bias is bearish, we can still take trades that are counter to the day's bias as long as we're taking them at good location where there's sufficient reward to risk. And in this case, because the range is being exhausted too, it increases the odds of a better bounce. Haas's question is, in terms of not fading the last hour trend, is it the trend of the last hour or the day's trend that we don't want to go against? It's really the trend of the last hour. So if the market is going directional in the last hour, we generally don't want to fade that. And keep in mind that these are guidelines, right? These are not hard, fast rules that get applied in 100% of situations, but they work about 80% of the time. But then every rule has an exception. So, in certain situations, it can still make sense to take that trade. Okay, so one last question here. Myron's question is, do you ever use trend lines? I don't. I don't draw trend lines. I can kind of see it, right, without drawing it, but I don't physically have trend lines on my charts. Sometimes if I post a chart on Twitter that's like a daily chart or a larger time frame, in that situation I might draw a trend line to make it very clear and obvious what I'm looking at. But personally, for my own trading, I don't draw them. But of course, I am visually aware of kind of what the trend is. You don't have to draw this line to know that there's a break here, right? You can kind of just visualize it. So even though I don't draw the trend line, I'm of course aware of what the trend is. And Haas, I don't use moving averages. So what you see on my chart is what I use. So, I use VWAP, the volume weighted average price, but I don't use those kind of more traditional, 50-day, 200-day, or 50-period, 200-period moving averages on any of my charts. All right, guys, so that's a wrap for today. So we'll just kind of quickly cover a little bit about the overnight session. So on the downside, I think the 79 to 81 area is still intact. And if we look at the larger time frame chart, you can see that the market was just really overdone. A little bit of a retracement, a little bit of consolidation is actually a very healthy thing for the market. Now, if we can continue holding above that 79 to 81 area, kind of over here, you can see visually, if we continue holding this area, then the intermediate term bias is unaffected. It still remains bullish, and eventually we could still make our way back up. So this is going to be an important spot. If we fail 79 to 81, then just like I covered in the morning video, we can get a move down into the next area of support, down at 67.5 to 70.5. And buyers can technically be active on first test of that area. But I think that if the buyers are really going to maintain control in a significant way, then ideally we want to see the market holding above this 79, 78 to 81, over here. So holding today's lows essentially. And if that's happening, then the bigger pattern still is okay. This ends up just being another trading range, and eventually the market would still have potential to go higher. So on the downside, this is kind of a key spot right now. If we look at the swing, we can see that this pop is basically a 38% retracement of this big downswing from today's high. And if we can now take out 91, then that would set up the market to go higher into the 95 to 2900 area. That can still be overnight resistance. And then if we take that area out, then of course it just confirms buyers dominant again, and then we can revisit the recent highs. So for now, the intermediate term bias is going to be unaffected. It'll remain bullish, and given the daily chart and just how strong this move has been, technically the intermediate's not really going to fall apart for quite some time. But ideally, you want to see the market holding above today's low if we're going to now consolidate and eventually head up into the 2930 to 2940 area, over here, right? And then the all-time highs wouldn't be too far off at that point in time. But let's just take it day by day. Don't have to really over predict or look too far in the future. Our trades live or die within a 5 to 30, 40-minute time span usually. So we don't have to look too far into the future. As long as we're aware of what the current pattern is, what the current environment is, that's good enough. All right, guys, that is a wrap for today. Thank you for everyone who attended, and anyone who didn't, of course, will get the recording. All right, guys, we'll update you tomorrow morning. Take care. Good night.